Hi traders, you're welcome to my channel. I am OTJOSH, and in this video we'll be talking about volume and understanding volume and price analysis. First of all, let's start with some common misconception we have about the way that the market moves. Most people would tell you, if you ask why do the price go up, they are going to tell you that the price goes up or is moving upward because there are more buyers and sellers. Or why does the price move down? They'll tell you the price is moving down because there are more sellers than buyers. Yet with this information, we still find it difficult. They still find it difficult to take advantage of the market price movement. And we've been told about this movement countless of times by experts, by analysts, and all of those people. So what I want to introduce here is a correction of this kind of misconception, because if we can get the reason why price move, we'll be able to track volume for almost any kind of stock or any kind of price action. So let's move on. So why do price move? Now let me tell you that price and volume are jointly determined. I mean, buyers are equal to sellers, and when buyers are equal to sellers, we have a trading volume. When buyers and sellers meet, we have a trade. So when shares bought is always equals to the shares sold. If you're buying $100 worth of shares, then someone else will be selling $100 worth of shares for that trade to go on. Therefore, the trading volume that will be calculated will be the buyers and the sellers shares, which will be equal to what? 100 shares. So this is that. So how do we now determine the volume or how the movement of price with this kind of information? So let's move forward so that I can explain more of these things to you with an example. Okay, now for example, we have a professional trader here. Here we have a professional trader and we have an amateur trader. Now we want to determine why do price move. Is it that price is moving because the professional traders are in the market, or is it because the amateur traders are in the market? What is the main core reason, the fundamental reasons for price moving? Is it because of some technical analysis like Elliott wave and what have you? Let's find that now. Okay, what is the characteristics of this guy here, this professional trader? I'm going to tell you. For one thing, I know he is very knowledgeable and he is very disciplined. This is something we all know about the professional traders. By professional traders, I mean the banks, the institution, that trader who is very good with his method. You understand what I mean? So now we have the professional trader buying at one hand, and the amateur, the novice, the newbie, the new kid in the block, the amateur trader, on the other hand, is selling. Okay, when the amateur is selling, the professionals are buying, right? Okay, so what will determine the movement of price? Will the price move up because the professionals who have more knowledge already know the direction of the market, or will it move down because the amateur trader, the novice trader, is banking his trading decision based on hope, like they always do, or fear or greed? Is this something that is going to make this price move? So let's find out why will it ever move in the first place? Okay, now let's move on to the next slide. So we'll find that. Okay, here is it. Now, first of all, let me explain what is going on here. Now, the professional trader with all his knowledge has found out that price will be going up, and the amateur trader without knowledge, trading irrationally, or maybe he has gotten into a trade by mistake he has found himself in a winning trade. He does not know, he does not have a process of getting into that trade. He just found himself in a winning trade, because to win in a trade you don't really need to be a professional. You just need a little bit of luck. Now, if he has found himself in a winning trade, at a point he may want to take his profits because he is happy now. Now, if he's taking his profit off the market, and the professional trader is going to enter into a position at the same time, you can see that these two traders are doing the same thing. They've agreed to establish a trade. That means the buyer in the market has agreed to trade with the seller in the market. Let me take this further. Let me explain this further to you. So now, this is the buyer in the market, this is the buyer, and this is the seller. Now, why would the price go up or go down? Understand that the buyer, which is the professional, has $100 to trade with, but the amateur has made 10 times more than the buyer is willing to trade with. Now, immediately the buyer perceives this opportunity and trades with this $100. What happened? The exchange broker is going to match his $100 here. Is going to match his $100 with $100 from this $1,000. This is how the trade goes. This is why price moves. Now, when the professional trader matches it up, what will be left with the amateur trader will be $900. Yes, it will be $900. Now, for this $900 to be, for the whole 1,000 naira to come back to him, you find out that since he has taken profit off the market, he has taken his profit off the market, the price will go down to look for the next $100. Yes, the price will go down to look for the next $100 without finding it, because the professional trader has only $100. It will go down and down, finding the next $100 until the price goes down low enough to see yet another trader who may be a professional who may be an amateur. For whatever reason, that trader is willing to buy $900 worth of shares, or is willing to trade at that price if it's forex or whatever instrument that trader is trading with. I hope you've understand this explanation. So to go back again, the reason why the price is going to go down is not because of the expertise of these traders, but because of money, because of the activities this money can do. And this activity can be said to be what? Volume. So this brings us to our topic, volume. It is volume that moves the market. It is activity that moves the market, not psychology, not emotions, no, it is the activity behind those emotions, which is volume. Now, if you have this for a downtrend, you find out that for an uptrend you still have the same thing. If you have this for an uptrend, you find out that a downtrend you have the same thing. In a downtrend, I only change the names, they are the same. You see, they are the same thing. If this guy here, who is a professional trader, is trading with $1,000, if he's buying, he needs someone to take the other side of the market. If the retail trader has only $100, then the retail trader is going to match with his $1,000. The remaining $900 will have to go up until that $900 has been exhausted by one or two or three people who has $900 in 9 places, or just one person who has $100 in one person who has $900. This is how it works. And so when that person comes into the market, that person is going to exchange at a point, is going to exchange the $100 for the $1,000, and this $1,000 will be left with $900. So at the time whereby this retail trader is trading with $100, believing that the price is going to go down, this retail trader would be at a loss, irrespective of whatever method he is using, irrespective of how good his method is. He will always be at a loss. Why? Because he cannot see the amount of money the institution are putting into their trade. It is not the technical analysis, it is not the tools the institution use, it is the money that determines the movement of price, not the expertise or the psychology of these people. So with that being said, if we are going to trade and we cannot see the money that is being used to trade in the market, what do we fall back to? We fall back to our volume indicators, because this is what it shows. We fall back to our volume bar. So you can see this. We have $1,000 of volume, we have $100 of volume. Now I'm using a monetary value here, but it doesn't have to be. I just use this for illustration based on the previous examples. So what we have here is a volume a price and volume relationship. This has nothing to do with price and volume analysis. This is just the relationship that I'm trying to let you know, that it is price, it is the money that determines the movement of price, irrespective of who is in the market. A novice trader who has enough money will change the direction of the market irrespective of whatever analysis anyone think he is using. So this is the common misconception. It's not because there are enough buyers or enough sellers. No, it is because there is money in the market. If there are more buyers than sellers, if there are 100 buyers than, if there are, let's say, 10 buyers to 1 seller, irrespective of those 10 buyers, if the 10 buyers each have $100 and the one seller has $20,000, you'll find out that the market is going to go down irrespective of the number of buyers we have. What will determine that is because of the amount of money. And volume is money, volume is force, volume is activity. It is this money that matters, not the technical analysis, not the fundamental, and nothing at all. It is this money that we have to follow to get our technical analysis. So let's move on to the next. So volume and price analysis involves gaining insight into the market by the use of activities of market participants. Remember, when I say activities, I mean money. By the use, we are looking at how market participants spend money, so we can analyze the volume and the price. So the volume analysis tends to interpret these activities side by side with price movement to understand the strengths and weaknesses behind price movement. Then we categorize this movement into 2 parts, namely anomaly and validation. And here is what we know as our own volume and price analysis. So before we get into anomaly and validation, before we get into this, I hope you've understand this misconception and you will be able to build a framework which you can use to understand volume and price analysis better. So let's move on to the next phase, which is an anomaly and validation, starting with an anomaly. So an anomaly in volume and price analysis represents a deviation between price and volume. It represents a deviation between price and volume, and this are the deviations we can see that this anomaly is posing. For instance, we have a huge spread. We are supposed to see a huge volume, but this is not what we're seeing. We're seeing a small spread, we're seeing a huge volume. These are all anomalies. What are these anomalies saying? In respect to our first example, we are seeing a volume a volume of, let's say, $100 here, $100 here, right here, but we're seeing the traders behind the $100 is up to sorry, is up to, let's say, 10. We have about 10 traders who are coming together to produce $100 worth of volume. That means this 10 trader has $10 each. So if you are not seeing volume, if you have no way to see the amount of money, when you see 10 traders in the market compared to one trader, you are always going to feel, oh, there is money with these guys. These 10 traders, they have so much money, and you may decided to trade with the information that they have given you, but you find out that it's just an anomaly, it's a false information. The same thing with this kind of trader. You may see just one trader in the market compared to 10 traders, and you may think, oh, what does one trader has to offer? But if you can see his pockets, you will find out that this one trader has $1,000, not even $10, not even $100. He has $1,000. So he can make an influence in the market. He can make an influence in the market if he wants to. The same thing for the downward movement. This is what an anomaly tells us. It tells us that there is a deviation between the price, that means the individuals in the market, and the money that they are having, that is the volume that they put into the market, the interest they have into the market, the force they have on prices. So after the anomaly, we have validation. What does validation mean? Validation is just like it's the correspondence between price and volume. So in this case, using our first example, if you're seeing an institution or a professional trader who is coming into the market, you can be sure that this person has enough volume to push the market. And if you're seeing a retail trader or the novice trader, you can be sure that this novice trader does not really have enough money to push the market. It does not have enough finances to push the market. And if you are going to go further to check, you find out that the volume is corresponding to what their own abilities. This is true for the down traders as well. Validation and anomaly, this is what they are meant for. So once we've gotten validation and we've gotten anomaly, what next are we going to do? We are going to look at how to interpret these validations and anomaly, because this is essentially what we use the technical analysis for. What does this volume and spread, what do the combination of this volume and spread actually mean? How can the trader take advantage of it? And then what will the market be telling us in the long term when we use volume and spread analysis? But before I go on, I want you to know that the volume analysis in itself, the volume analysis on its own involves, now I'm not talking about money, I'm not talking about insiders, I'm talking about volume analysis from a technical perspective, in a way we can use it. What we are going to do is that what we want to gain with volume analysis is having the insights into the markets by the use of the activities of market participants. The use of the activities means the use of the money these people are putting into the market. And this volume can be high, it can be low, it can be average. So the volume analysis will therefore tend to interpret these activities side by side with price movements. And when we can interpret this activity, which we are going to do next, side by side with price movements, you'll find out that we'll be able to understand the strengths and weaknesses behind these price movements. And then we can now start saying that, oh, this price movement is being carried out by the professional, this price movement is being carried out by the retailer, or the professional is trying to do this, the retailer is trying to do that. The moment you are being able to anticipate what the market is going to do next by the understanding of volume analysis, you'll find out that you have a skill that very few traders has. You have a skill that most traders will not even want to let you know about. So let's go on. But before we do that, we're coming to the end of the year, so I'll humbly ask you to like, share and subscribe. We have about 980 subscribers now, so if you can assist me to get the subscribers and the statistics the statistics over 100 subscribers before the next year, 2024. So it's going to cost you nothing, just a click of the button. So you can assist me by subscribing to the channel, liking this video, share this video, and if you have a comment about this topic or any other topic, you can leave it on the comment section. That being said, let's go on. Okay, so now the first example will be the example of a high spread and a high volume. Now, as usual, we can see that the high spread and the high volume is a validated price action. This is very straightforward. So a high spread on high volume signifies interest from the markets. When the spread is high, accompanied by high volume, it signifies a continuation of the current market sentiment. That means if there is money in the market and we see that this money is being put in the market by the professional traders, by the big banks, by the insiders, by the how will I call it, the hedge funds. These are the guys who move the market. If there is a high volume in the market and the price has been trending, for instance, in the upward direction, you find out that uptrend will tend to continue. Or we have a bullish candle and a strong volume, you find out that in the future the price will always go in the direction of the bullish candle. It will not reverse. Why? Because there is enough money pushing that price upward. Same thing for a downtrend. If the trend or the price has been coming down, the bearish candle has been coming down with a strong volume, you find that in the nearest future the price is not going to reverse, because there is enough force, there is enough interest in that downtrend, there is enough force behind that downtrend, there is enough money behind that downtrend. So for the downtrend, the insiders are in the market. For whatever reason any other person has, if that person is going to trade with a $10,000, the insiders will never trade with $10,000. They trade in millions of dollars. So your $10,000, you may have a very good reason to want to go against the trend, but I bet you your $10,000 will not help you. It's going to betray you, and you are going to lose that money. Why? Because at that point the insiders are in the market and they are always right. This is what the high spread and the high volume means. So it signifies a continuation of the market sentiment. It gives traders a belief on holding in on any position they may have taken. If you have taken a position before and you start saying this, you have more belief in holding this position, or you start looking for opportunities to add to this position. So this is a validation of price and volume by the market. The significance, it signifies the interest in the market and the presence of the big players, the big boys. So going further, we have the next kind of volume, which is a high spread on low volume, and this is where we have an anomaly, a high spread on low volume. What is really happening here? How can the price be going up a high spread but the volume is low? So if we say the price is going up, what does that represent? It represents the presence of the insiders, the professionals, those who know what they are doing. These are the people who should be taking the price, right? But if we had no volume, this is what we are going to assume. But now we have the volume to see that if these are the insiders, why is the volume low? This is what the question is. Why is the volume low? It's low because there is something we call the market manipulation that happens in the markets. We have a high volume, but yet a low volume, yet a high spread. So who are these people who is deceiving the markets, thinking that, making us believe that the market is going to move on, yet they are not putting any form of investment, any form of money into the market? Who are they? Who are those people? Now I'm going to tell you, these things happen not because the brokers or the market wants to rip us off of our hard-earned money. What is happening here is simply this: these traders here are not the insiders. They are not the insiders. They are the amateur. They are the retail traders, the everyday traders. Now, why is the volume high? This volume is high because of sentiments. These traders, they act based on emotions of fear and greed in the downtrend and in the uptrend respectively. Now, when this trader hear about an investment, they may hear about a news from a friend, a technical reason to get into a trade, any news whatsoever that is going to give them the next big hit, the next big money, their dream money, their dream car. What happened? They rush into the market. When they rush into the market, at that moment the price in the market moves up. But one thing cannot lie: the volume, because they will rush into the market with little amount of money. So when they do this, you know that this volume this volume is contradicting the price. So there is an anomaly within this price and this volume. I want you to pay attention. So when you have an anomaly in that uptrend or in a downtrend like this, what does this tell us? When the price and volume has an anomaly like this situation, what it tells us is to wait, not to join. There is a trading strategy that involves observing. It involves standing at the sideline, and this is the signal for you to stand at the sideline. Don't trade with them because they are acting emotionally. So when you see something like this, you can see this in some of my live trading videos. You wait. So what are you going to wait for? You're going to wait to see a validation in the opposite direction, because they've already shown you clearly that this direction in price movement is not valid. It may be moving up, but is not a valid movement. We want to always be in the side whereby the professional resides. So when you see something like this, you should know that this is just the market testing the retail traders. The market wants them to come out, because if they can come out in great numbers, you find out that the insiders, if they can come out in great numbers, you find out that the insiders will be ready to do what? The insiders will be ready to carry out an operation like this. Yes, the market will be going, sorry, like this. Let me use this. Yes, the market will be going up by the by the retailers, the high volume. It will be going up, but on low volume. This is a downtrend example, but it's the same thing. It will be going up just so that the price can get to the point where the professional wants to sell. And when it gets to that price, what happens? It exchange. The professional sell a huge amount of volume. It sells a huge amount of volume to this little spread, and what happened? The price falls down. Now the retail trader becomes stuck in their position because they fail to understand the use of volume in price analysis. So let's move to the next one, or let's okay, they fail to understand the use of volume in price analysis. So high spread on low volume signifies lack of interest in the market from the perspective of big players and retailers. So if you are going to compare between the amateur and the retailers, who is this kind of anomaly signaling? What is this signaling? You find out that it's a lack of interest from the retailers. Sorry, from the professionals. It's not from the retailers, from the professionals. They are not interested in trading at that time. Only the retailers are interested, and they are very interested, and that's why you see the high volume in the market. So it can be clearly seen that the big players are not in the market, so they are not involved in the high spread up candle. So the high spread up candle is now as a result of retail traders acting emotionally out of greed or fear of losing out in what they perceive as a opportunity or as an opportunity. So as traders, we always want to avoid this kind of setup and go with the group of traders that have the power to move price, because these traders, one thing you observe is that their reality is far from the objective of the market. The market is being controlled by the professionals, the big institutions, but the realities of the retail traders is not in line with the realities of the professional traders. So the low volume clearly shows that the insiders, the professionals, once again, are not in the market. Otherwise, if they were in the market, you'll find out that this volume is going to be high if they were in the market. So since they are not in the market, what happens? Volume is low. The same. So let's move on to our next volume and spread analysis. This is a validation, and for this we have a low spread and low volume. Low spread and low volume, it occurs as a result of trading activities that is carried out. Listen, this is very important, because we may be saying, oh, this is an anomaly, it's a low spread. No, it's not. It occurs as a result of trading activities that is carried out only by retail traders. So these low spread candles are a valid move because they clearly show the participants behind the move. The low volume emphasizes this feature. Yes, the low volume reflects the strength of only the retail traders. So because retail traders have very little impact on the markets, so the low volume will reflect their impact. So this low volume is not deceiving. It's telling you the truth that the retail traders are in the market. There is no form of anomaly there. So this is a validation of price and volume, and it is a sign that the current price action is likely to hold, but not for long. The current price action is okay. It's okay. There is no cause for alarm, but the direction of that price action will not stay for long. This is what the low spread and the low volume is telling us. So because the reason why it does not stay for long is because the retail traders, they are mostly short-term traders, they are emotional traders. They just want to have their profit, unlike the professional trader who can keep their trade for weeks or months. The retail traders, they want to trade for the next 10 minutes, the next 5 minutes. So this is what I'm trying to say. They want to get their profit as quickly as possible. So when you see a low spread on a low volume in the market, you are going to know that, okay, you can take advantage of this price movement on the short term. When you make it, whatever money you want to make from that movement, you leave the market at once. But basically, you can altogether ignore such kind of price movements depending on your level of experience. So let's move on to the okay, the last part of this, which is the low spread and the high volume. Now this is where we see the retailers doing the trick by themselves. Now low spread shows the presence of retail trader, just like we've seen in the previous example. This is an anomaly, a low spread. But the high volume, how can the retailers have high volume? This is an anomaly. So what does this represent? When the low spread shows, if the low spread represents the presence of retail traders, but in this case a high volume represents the presence of the insiders. So we have a contradiction here. On one hand we have a low spread, and on the other hand we have the high volume, which we know that the retailers cannot do. The retailers does not have volume to move price. So what this represents is that both retailers and the professionals are selling, they are buying and selling at the same time. I want you to understand that this represents that both the retailers and the insiders are buying and selling at the same time. While the retailers are busy buying, the insiders are selling at the same time. So this buying is being suppressed by the selling. As a result, the spread of the candle becomes low, but the volume increases. So when the retailers are buying, for instance, let me use this. For instance, the retailers are buying like this. They are buying. The insiders are selling, buying, selling, buying, selling. But something is happening below. What is happening below is that this buying and selling movement is causing volume to rise, 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 rise. But at this point it will be buying, selling, buying, selling, buying by the retailers, selling by the insiders, buying by the retailers, selling by the insiders. At the end of the day, what we'll have is this. The candle is going to close small because of buying and selling activities at the same time, but there will be enough volume. So the thing is this: why is this price action and volume relationship, why is it important? Like I said, why the retailers are busy buying, the insiders are selling at the same time. So this buying is being suppressed, and the selling, this buying by the retailers and the selling by the insiders will cause the price to be suppressed. But then the the volume will be increased, because the volume will show the activities of buying by retailers and selling by insiders. So in a case like this, it signifies the market is about to reverse. Yes, it signifies that the market is about to reverse, and the retailers will be stuck in in weak positions. This is what the price and volume relationship is. When the retailers are when the price and volume relationship is like this, it means that the professionals are selling to the retailers, or the retailers unknowingly are buying, but they are buying yet the price is not moving, and they keep on buying. Why are the professionals selling? Because they've already gotten the profit they want to get, so they'll sell at these points little by little, and when they've said everything they want to sell, the price will fall down, and it will trap these retailers in weak positions, and they will run out as losers. So this is what an anomaly and validation, this is what they really mean, and this is these are the examples or how they are being expressed in the market. So once again, an anomaly in volume and price analysis represents a deviation between price and volume. Like I said, it includes the high spread, low volume, low spread, and high volume. So an anomaly is a signal of a potential change in market direction due to some shift in market sentiment or perceived opportunities by market participants. By market participants, I mean retailers and professionals. So when an anomaly occurs, when you see an anomaly, it tells us to watch out to know the participants driving the market at that particular time. So as traders, we always want to identify with the participants, whether insider or retailers. We always want to identify who is driving the market. But when we identify this set of individuals driving the market, we want to stick with trading in the direction that the insiders are. Even though we know that this market is being moved by the retailers, we want to know and not do anything. But when we know that the market is being moved by the professionals, we want to know and then get ourselves ready to take advantage of it. So on the other hand, validation occurs when what we see in price movement is in accordance with volume. So validation, we all know, high spread, high volume, low spread, low volume. So in a case like this, we know that the high spread shows the presence of insiders taking price in their direction, and the low spread shows retailers taking price in their direction, but not for a long period, just for a short period of time. So once again, I want to let you know that if you can understand the volume and price relationship, the anticipation of price movements will be very easy for you. It will be very easy for you. It takes time to learn. It takes time. You have to give it your time. Some few days or weeks, you will be proficient in this way of analyzing market data. But I believe this is the only way you can truly get to know what is happening in the market, because it is highly manipulated. You can easily burn yourself if you are relying only on price action, because the price action you see in your screen is not always the true case of what's happening in the market. So this will be the end of this part of this video. Please like and share this video. Help me get to over 100 subscribers before the new year. That should be my gift, my new year or Christmas gift from you guys. You can help me so that the channel may grow more, and we can move on to other parts of trading and making money through this means of forex trading. So for now, this will be the end, and I will be wishing you a happy new year in advance. So let's make this happen. Subscribe, like, and leave a comment if you have any comments if you have any questions regarding this video or any other video in the past. And always make sure you watch the video and practice, or try to study what I have just explained, so that you can get good insights about how the market really works. So until next time, I'm wishing you a happy Christmas and a prosperous new year in advance. Bye bye, and God bless you.